When to start investing is only one of the numerous queries that new investors have. What should you put money into? Whose financial counsel should you heed and who should you disregard? Why must investing be so difficult if it is so crucial to your financial future? It's not essential, which is fantastic news. These 12 basic suggestions for beginner investors show how to simplify the complicated process of learning how to invest. Before starting, click on the subscribe button for more interesting and informative videos like these. Let's start. Number 1. Start now. Starting is the hardest challenge for a novice investor. According to Nicholas J. Scheibner, a wealth management advisor at Barron Financial Group, this is the ideal time to begin investing. He advises against holding off until the ideal moment to enter. Start right away and keep building it. In addition, he advises beginning their first year of investing as though they will lose money. Recognize that investing can sometimes result in a loss of capital and that this doesn't always mean that something went wrong. It probably means exactly the opposite, that you should buy more things while they're on sale. Number 2. Focus on your savings percentage. Poor portfolio performance has the potential to mislead novice investors, much like sensational headlines. When your portfolio experiences a loss, it's simple to question your investing choices, yet stock market losses are inevitable. Ben Hakima, a registered financial advisor at Illuminate Wealth Management, advises concentrating on your savings rate rather than your portfolio's performance. He claims that continuing to invest and setting aside enough money are the two most crucial factors in long-term investors' success. You have some control on how much money you save, even though you have no control over your investments. Hakima contends that novices will have a very good chance of success if they consistently concentrate on maintaining or raising their savings rate. Number 3. Set investment goals. Finding your investing aim is the first step in developing an investment strategy. Rob Williams, Vice President of Financial Planning at Charles Schwab in Denver, advises that you list your short, medium, and long-term objectives along with a monetary value for each one. Next year, a trip to Greece might be on the short-term agenda, and saving for a down payment on a house might be on the long-term agenda. According to him, a smart strategy for maintaining your motivation to keep investing and saving is to have clearly defined goals. Your understanding of how to invest throughout each goal is aided. Number 4. Don't let the media scare you. The most important piece of advice licensed financial planner Andrew Langdon, who founded 5 Points Financial Planning, would provide to novice investors is to realize that you, as an investor, and the media have very different objectives. The aim of the media is to draw viewers, which they frequently achieve by creating intriguing headlines. Langdon claims that if your objective as an investor is to increase your wealth over time, you can do it by concentrating on elements such as time horizon, risk, costs, and taxes. A recent study found that those who don't try to time the market and don't frequently modify their portfolios will perform better over the long term. Try to maintain a clear head and make judgments based on your investing plan, not the newest headlines, when reading articles predicting the impending stock market Armageddon. Number 5. Use goals to determine your time horizon. According to Lamar Watson, licensed financial advisor and owner of Dream Financial Planning, the objectives of your investments will have a significant impact on how long you want to hold onto your money. The length of time you must wait before using the money you are investing in is known as your time horizon. According to Watson, this may be the most significant element in deciding how much risk you can tolerate. Your time horizon should be as long as the level of risk you are willing to accept. If your time horizon is longer than 10 years, you can lean more heavily toward stocks. If your time horizon is between 5 and 10 years, you should have a good mix of stocks and bonds. If your time horizon is shorter than 5 years, you shouldn't have any stock exposure. If your time horizon is less than 2 years, you should only have cash and cash alternatives like certificates of deposit. Number 6. Start with broad-based investments. The crucial decision new investors must make after determining whether to invest is what to invest in. Williams claims that the wealth of investment options can make making a choice difficult. Fortunately, there is an easy way to get started with broad-based mutual funds and exchange-traded funds, which pool the money of many people to buy a variety of securities. Choose the percentages of cash, bonds, and stocks that you intend to invest in, before filling in the gaps with funds that match to your chosen allocation. Number 7. Don't be afraid to ask for help. There is no requirement that investing must be a solitary activity. Partner, Vice President, and Wealth Advisor Stacy J. Miller of Bright Investments claims that her best advice for newbie investors is to seek advice if they are not specialists. You might get assistance from a financial advisor, who is not only for the wealthy, with any problem you might be having. To be on the safe side, Miller advises screening any advisor carefully, as you would someone who will look after your children. Find out about the certifications held by potential advisors and if they are fiduciaries. Chartered financial analysts and certified financial planners are recommended since they display years of additional education, training, and skill, according to Miller. Advisorinfo.sec.gov can be used to confirm their credentials. Next, find out how much they get paid and what working with them will cost you. Number 8. Get to know your risk tolerance. Never take on more risk than your investment objective and risk tolerance will allow. Simply because you can doesn't mean that you should increase your level of financial risk. Your allocation to stocks and bonds will define your level of risk. More risk is associated with more stocks. Your financial objectives will determine the allocation you make, according to Mike Hennessy, founder and CEO of HarborCrest Wealth Advisors in Fort Lauderdale, Florida. Is similar to the speed you choose to drive your car at. No one wants to go from 65 miles per hour to 35 miles per hour in a matter of seconds. Therefore, according to him, your allocation should remain mostly steady over time but fluctuate as you get closer to your investing objectives. Number 9. Keep your costs low. Although you have no control over how well your investments perform, you do have control over how much they cost. Michael Pappas, founder and CEO of Amity Financial Planning, advises novice investors to pay close attention to an investment's costs. According to Morningstar's most current cost study, actively managed funds generally have expense ratios of 0.67% or more, whereas index funds typically have expense ratios of 0.15% on average. According to Pappas, over time, these rising costs might eat away at the return on your investment. Number 10. Start thinking about your pension. Starting to prepare for retirement can be done at any time. If you're in your 20s, we don't blame you if saving for retirement isn't your top priority. Early preparation and money management can help you take control of your retirement sooner rather than later. If you're in your 30s or 40s, it might be a good idea to check your state pension and employer-sponsored pension funds now. Start by posing some important questions to yourself. Will it be enough to retire on? If not, is there a way to maximize your retirement income? You might be able to improve your retirement savings by starting a personal pension, commonly known as a self-invested personal pension, SIP. With a personal pension, you can save as much as you like for retirement. And any earnings you make are tax-free in the UK. There's more, though. Additionally, you will receive a 20% tax relief from the government to make up for the income tax you already paid. Number 11. Automate as much as you can. When everything is set up, Williams advises automating as much of the investment process as you can. Set up monthly payments to your non-retirement investment portfolio, automatic savings deposits, and contributions to your retirement account. He thinks that if there is less work for you to do, it will be less intimidating and you'll be more likely to remain with it. Having said that, you should continue participating to ensure that your assets and allocation are still in line with your goals. He suggests reviewing your portfolio at least once a year. If that's what you desire, he advises, your thinking should be long-term. Try to maintain a long-term perspective and refrain from overreacting or altering plans in response to merely short-term turbulence. Number 12. Consider diversifying your portfolio. Regardless of your investment approach, it is always a good idea to try to lower your risk. You may diversify your portfolio and lower your chance of losing money by dividing your money among different investment types and regions. Think about this. If you invest all of your capital in one or two companies, you can be in for an unpleasant awakening if those companies struggle. The danger that you will lose all of your money will now decrease. If you buy a variety of investments of different types such as shares, bonds, and property and take part in many financial markets, having a varied portfolio of investment funds could help keep your account stable when various markets rise and fall during an economic cycle. Making all of your investments in a single sector of the economy, industry, or company may expose you to unanticipated issues there. The benefits of investing across a number of asset classes, geographies, and businesses outweigh any potential risks and maximize long-term gains. What do you think of our video? Let us know in the comment section below. Don't forget to like and subscribe our channel for future updates. Thanks for watching.